Assalamu alaikum, dear students. Hope you are well. I am Mohammad Samad Khan, lecturer, Department of Accounting, Dhaka College, Dhaka. Today I am discussing the topic relevance of dividend decision. I mean different theories. There are many different theories. There are Walter's model or Gordon model and model. So today we are discussing about Walter's model. Okay, dear students, let's start our class about Walter's model. Dear students, Professor James E. Walter told that told that the choice of dividend policy the choice of dividend policy affect the value of the firm almost everywhere affect the value of the firm. So it is the earlier works in dividend decisions, it is the earlier works. So in this theoretical works shows that the relationship between IRR, I mean internal rate of return, and the cost of capital, the relationship between internal rate of return, I mean R, and the cost of capital in determining the dividend policy. So we should learn. We already know that what is the dividend and how we distribute the dividend among the shareholders. Okay, so dear students, all of the model are stand on some assumptions. So Walter models has some assumptions. The assumptions are: one. So, dear students, the assumptions are: one is internal financing or retained earnings is used for financing. So here already said that just internal financing or retained earnings is used for financing. So here there's no external financing. Okay, it is the one of the assumptions. Okay, then two, the firm finances all investment through retained earnings. I mean through retained earnings, I mean through profit. Okay, that is debt or new equity is not issued. So here there is no equity and there is no debt, just retained earning. Retained earning will be invested in new project or business. Okay, then 3 number is the firm's cost of capital K and rate of return are constant. Here both of true. I mean cost of capital and internal rate of return are constant. I mean fixed. It never be changed here. So for 100% payout ratio or retention. I mean dividend policy follows here that 100% payout ratio or retention. I mean here if dividend a company company's dividend is 10 taka, so there is uh, paid or distribute total 10 taka as a payout ratio as dividend by payout ratio, or total 10 taka will be invested in invested area, right, or in business. It is retention. Okay, and then here 5, EPS and dividend are assumed constant. So here we should say beginning EPS, beginning earning per share, and beginning DPS are constant, but ending EPS or dividend may be, DPS, dividend per share may be changed. But first time, beginning dividend or earnings, beginning earning per share, earnings and dividend must be constant. Okay. 6. Going concern is assumed. So the company has a long life or infinity life. The company has a long life or infinitive life. Okay. So the price of share according to the Walters model, the price of the share according to Walters model, say P equal, we should say DPS plus R by K, R internal rate of return, R by K, K cost of capital, and then EPS, earning per share, minus DPS, which is called EPS, E, DPS, D, and then here is K, cost of capital. So it is the price of the share. Okay, dear students, we already learned that what are the assumptions of the Walters model. So Walter model is based on these assumptions. Okay, dear students, category of firms. Category of firms. First one is growth firm. First one is growth firm. Growth firm. What is the growth firm? Growth firms are those which expand rapidly. Which expand rapidly. Here always R is greater than K. Internal rate of return is higher than the cost of capital. So we should say these firms are able to reinvest earnings at a rate which is higher than the shareholders' expectations. Okay, so here in this growth firm, here the payout ratio is 0. Total dividend must be invested. Total dividend must be invested. So payout ratio is 0. Okay. Then 2 is normal firm. Normal firm. Here normal firm, the firm whose are normal in this firm R equal K. Here R equal K. Internal rate of return equal cost of capital. Okay. Then 3 is declining firm. 3 number is declining firm. Declining firm is those whose internal rate of return is less than cost of capital. Okay. Declining firm is declining firms are those whose internal rate of return is less than cost of capital. So here it is R is less than K. Okay, dear student, I think all of you already learned what is the growth firm, what is the normal firm, and what is the declining firm. So we should say in a nutshell that retain all earnings, retain all earnings retain all earnings. Here R is greater than K. I mean in growth firm retain all earnings. I mean all of the earnings are invested then distribute all earnings. I mean R is less than K. Okay, then be indifferent, be indifferent as dividend or retention. Dividend or retention policy has no impact. Okay, so here R equal K. Here R equal K. So here already learned that retained all earnings. I mean in one growth firm retained all earnings and then distribute all earnings. I mean all of the earnings will be distributed among the shareholders. Among the shareholders there is no retained earnings. Okay, in this tree which is declining, which is called declining firm, and then being different as dividend or retention policy has no impact. I mean R equal K. Okay, so dear students, we learned that what is the growth firm and normal firm and declining firm. So now we are discussing the criticisms of the Walter's model. Criticisms of Walter model. First one is constant returns. Second one is constant opportunity cost. Then third is no external financing. No external financing is used, right? So here criticism, constant returns. In reality, we think that there is no constant, I mean fixed returns. Maybe it will be fluctuated, okay? Then two, constant opportunity cost. I mean always opportunity cost or capital cost always not be constant. Always not be constant. It will be changed, maybe. Okay. Then no external financing is used. Already we learned in the assumptions that internal financing is used for financing. I mean dividend. It will be payout. It will be retained. Right. So no external financing is used. I mean there is no debt or equity will be used. So it is the criticisms of Walter's model. Okay, dear student, at present we are solving a maths about Walter's model. Okay, So we solve a maths. Al Wajid Limited earning per share 16 taka. Earning per share, every share is 16 taka, and declared 5% dividend on its 100 taka face value. Okay, so the cost of capital K is 12% and the internal rate of return is 15%. So what will be the value per share according to the Walter's model? So we will bring that the value per share. Okay, so value per share P equal DPS plus R divided K into E minus D, I mean EPS minus DPS divided K. Okay, so we should say here D is dividend, I mean DPS, dividend per share. So dividend per share is 100 taka face value into 5%, I mean 5 taka. Okay, okay, I mean 5 taka. So 5 plus R, I mean 15% divided K is 12% into EPS 16 taka minus 5 taka. Then overall cost of capital is 12%. Okay, dear students, so five taka plus 15%, I mean 0.15, 0.15 divided 0.12 into 16 minus 5, I mean 11. 13.75 plus 5, 13.75, 12%. Okay, then 5, 18.75, 12%, then divided 0.12. So 156.25 taka. So value per share is 156.25 taka. So in this question, last one, Azad Limited earning per share EPS, I mean E is taka 16 taka and declared 10% dividend on its taka 100 per share face value, I mean face value 100 taka. Then cost of capital is 10% and internal rate of return is 15%. So you should or we should find out the value per share under one is if 50% retention is made, I mean 50% retention is made, I mean 50% payout ratio. Then two is if 100% retention is made, And then third number is if 0% is retention. I mean here payout ratio is 50%. Here payout ratio is 0%. And here payout ratio is 100%. I mean we should pay the dividend to the shareholders or to the shareholders total dividend, total profit, okay, total EPS, okay. So first one is 50% retention. So 50% retention. So here payout ratio is 50%. Okay, so here given that EPS equals 16 taka, then DPS is DPS is 100 taka, 110%, 10 taka. DPS is 10% dividend. I mean DPS is 16 taka into 50% equal 8 taka. Then here K is 10% and R is 15%. Okay, so we should P equal D plus R by K into E minus D divided K. So DPS is 8 taka. DP 8 plus R is 15 divided 10 into 16 minus 8 divided 10%. Okay, so 0.15 divided 0.1 into 8, 12 plus 8, 20 divided 0.1. So here is 200 taka. Value per share is 200 taka when retention is 50%. Okay, then 2 number, if 100% retention is made, I mean 100% retention, say P equal D DPS plus R by K into E minus D divided K. So here DPS, I mean 100% retention is made, so DPS is 0 plus R by K, R by K, R 15K 10 into 16 minus 0, 10%. Okay, so 15% into 16 divided 0.1 time, I mean 240 taka. And then last one is 3, where P equal D plus R by K into E minus D divided K. So D 3 number, if 0% is retention, I mean 0% is retention, I mean total EPS, I mean 16 taka, total EPS, I mean 16 taka is distributed among the shareholders. Total profit, total EPS earning per share is distributed. Payout ratio, there is no retention. So DPS is 16 taka plus R 15K 10 into 16 taka minus D DPS 16 taka divided 10%. Okay, so here the value is 160 taka. So in 3, value per share is 160 taka when 0% is retained. I mean, in this case, 100% payout ratio. So, dear students, I think all of you already learned the Walters model and how we bring out the value per share P according to Walters model. And next class we will discuss about Gordon models. Thank you all.